Before we begin, please note that the information provided in this video is for general informational and educational purposes only. I am not a licensed insurance professional, financial advisor, or attorney. The content of this presentation is not intended to be a substitute for professional advice. You should always consult with a qualified and licensed professional for advice tailored to your specific situation before making any decisions regarding your insurance coverage. There's a piece of paper that arrives in your mailbox or your inbox every 6 months. You probably glance at it, see the price, and then file it away, maybe in a drawer you call the important stuff I'll look at later drawer. For millions of Americans, that single piece of paper is a ticking time bomb, and they have no idea. That paper is your auto insurance declaration page, and ignoring it is one of the biggest financial mistakes a driver can make. Imagine this for a second. You're driving home from work, maybe listening to a podcast, thinking about dinner. The light turns yellow, you slow down, but the car behind you doesn't. You hear that sickening crunch of metal on metal. It's a classic fender bender. Annoying, but not the end of the world. You and the other driver exchange information. They seem okay, you seem okay. You call your insurance company, you open a claim, and you think, this is why I pay my premium every month. I'm covered. A week goes by. Then you get a letter. It's not from your insurance company. It's from a law firm. The other driver, the one who seemed fine, is now claiming a severe neck and back injury. They're suing you, not for $5,000 to fix their bumper. They're suing you for $250,000. For medical bills, pain and suffering, lost wages. Suddenly your heart is pounding. You pull out that insurance policy. Your hands are literally shaking as you try to read the fine print. You see a bunch of numbers like 50/100/25. It looks like a secret code. You call your agent in a panic and you ask the one question that matters. Am I covered? And that's when you hear the 5 words that can shatter your financial life. You don't have enough coverage. That $250,000 lawsuit? Your policy only covers the first $50,000. The remaining $200,000? That's on you. That's your problem. Suddenly, the lawyers aren't just looking at your insurance policy. They're looking at your house, your savings account, your retirement funds, your kids' college funds. Everything you have ever worked for is now on the line because of a few numbers on a piece of paper you never took the time to understand. This isn't a scare tactic. This isn't a 1 in a million horror story. This exact scenario plays out in courtrooms across America every single day. And it all comes down to that one document, the declaration page. It is the single most important, yet most misunderstood part of your entire auto insurance policy. It's the summary, the cheat sheet, the contract that spells out in black and white exactly what your insurance company promises to do for you. And more importantly, what they won't. Most people think car insurance is a product. You buy it, you pay for it, it works. But that's not true. It's not one product. It's a bundle of a dozen different products, each with its own price, its own limit, and its own purpose. And the declaration page is the receipt that lists every single one. Paying your premium without reading this page is like buying a house without doing a walkthrough. It's like buying a parachute and not checking if it's packed correctly. You are paying for a promise of protection without ever actually reading the terms of that promise. And that is what we are going to fix right here, right now. The purpose of this video is simple. I am going to demystify every single line of the auto insurance declaration page. We are going to translate the jargon, decipher the codes, and expose what those numbers actually mean for you, your money, and your family's security. By the time you finish watching this, you will be in the top 1% of drivers who actually understand what they are paying for. You will be able to look at your own declaration page and know with absolute certainty if you are properly protected, if you are dangerously exposed, or if you are wasting money on coverage you don't even need. You will have the confidence and the vocabulary to call your insurance agent and have an intelligent conversation, not as a confused customer, but as an informed consumer who is in complete control of their financial safety net. For years, I was just like you. I got my renewal, I looked at the price, and if it didn't go up too much, I paid it and forgot about it. I assumed full coverage meant I was fully covered for anything. I was wrong. Dangerously wrong. The term full coverage is a myth. It's a marketing phrase, not an insurance term. And the moment I realized that, the moment I actually sat down and forced myself to learn what each line on my declaration page meant, was the moment I went from being a passive victim of the insurance industry to an active manager of my own risk. It was a complete game changer, and it's what I want for you. So here's how we're going to do this. We're going to go through a typical declaration page section by section. We'll start with the easy stuff: the named insured, the policy period, the vehicles and drivers listed. This is the foundation. But then we're going to dive deep into the heart of the policy. We are going to tackle the most critical and most confusing coverages one by one. We'll break down bodily injury and property damage liability. This is the part that protects your entire net worth when you cause an accident. We will talk about the state minimums and why they are a financial trap designed to make you feel safe while leaving you one lawsuit away from bankruptcy. We'll unravel uninsured and underinsured motorist coverage. This is the part that protects you when you're hit by someone with little or no insurance. I'm going to show you why, in many states, this is the most important coverage you can possibly buy. We'll clarify medical payments or personal injury protection, explaining how it covers your own medical bills regardless of who is at fault. And of course, we'll cover the coverages for your car itself. Collision and comprehensive. We'll talk about deductibles and how choosing the right one can save you hundreds of dollars a year. We'll even touch on the optional coverages like rental reimbursement and roadside assistance, and help you decide if they're worth the extra cost. This isn't just going to be a lecture. This is a masterclass in financial self-defense. Your car is likely the second most expensive asset you own, but it's also the most likely to create a massive liability that could threaten your most expensive asset, your home. Understanding this document is the firewall between a bad day on the road and a financial catastrophe. So, if you have your own declaration page handy, I want you to grab it. If not, don't worry, I'll be showing you examples of everything. Get ready to take some notes. Turn off the distractions, because what you are about to learn isn't just about car insurance. It's about taking control of your financial future. It's about swapping anxiety and confusion for confidence and clarity. Let's begin. The first thing you need to understand is that your auto insurance declaration page is not a bill. It's not a receipt. And it's definitely not junk mail you can just glance at and toss. Think of it as the constitution of your financial protection on the road. It is the single most important document in your entire policy. It's a legally binding summary of the promises your insurance company has made to you and the promises you have made to them. It's the blueprint that determines whether a car accident is a manageable problem or a life-altering financial catastrophe. So pull out your declaration page. If you don't have a paper copy, log into your insurance company's website or app right now and download it. It's usually a 1 or 2 page PDF. Got it? Good. At the very top, you'll see the simple stuff: your name, your address, the name of your insurance company, and most importantly, your policy number. That policy number is your unique identifier. It's the key that unlocks everything. When you call your insurer, when you file a claim, when a police officer asks for proof of insurance, that number is your direct link to the protection you're paying for. Memorize it? No. But know exactly where to find it in a split second? Absolutely. Right below that, you'll find a section often labeled Named Insured or Insureds. This seems obvious, but it is one of the most misunderstood and critically important parts of the entire document. The person or people listed here are the primary owners of the policy. They are the ones the insurance contract is with. So what does that actually mean for you? It means the promises of protection are made to them. If your name is on that line, you're covered. If your spouse's name is also on that line, they're covered. But what about your 17-year-old son who just got his license and drives the family sedan? What about your girlfriend who lives with you and occasionally borrows your car? This is where people get into serious trouble. They assume that because someone lives in their house, or because they gave them permission to drive the car, they're automatically covered in the same way. That is a dangerous and often false assumption. Most policies extend coverage to resident relatives and anyone who has permission to use your car. But the terms and limits of that coverage can sometimes differ. And if you have a child who recently moved out to their own apartment but still borrows your car on weekends, they might have zero coverage under your policy. I once worked with a family, a wonderful couple who had added their daughter to their policy when she was 16. Years later, she graduated college, got a job, and moved into her own place across town. They were so proud. She was still driving the old, reliable car they'd given her. And to save her money, they just kept her on their policy. They never thought twice about it. One rainy Tuesday, she was in a fender bender. Not a big deal, she thought. She called the number on the insurance card, gave the policy number, and a few days later, her claim was denied. Utterly, completely denied. Why? Because she was no longer a resident relative. She wasn't living in their household. The policy, as written, no longer covered her as a primary driver. They had to pay for all the damages to both cars out of their own pocket. It was a devastating and completely avoidable financial lesson. Look at your declaration page right now. Who is listed as a named insured? Who is listed as a driver? Are they the same? Is everyone who regularly drives your vehicles listed somewhere on that page? If not, you need to call your agent or company immediately after watching this. Don't assume. Verify. Next, you'll see the policy period, or effective dates. This is the time frame during which your policy is active. It's a start date and an end date. Your shield is up between these two dates. The moment that end date passes, your shield goes down. And if you don't renew, if you don't make that payment, you are driving completely exposed. Let me be crystal clear about what a lapse in coverage means. It's not just a slap on the wrist. If your policy expires on a Friday at 12:01 a.m., and you get into an accident on your way to work Friday morning, you are personally on the hook for every single dollar of damage. The other driver's medical bills? That's you. The repairs to their brand new SUV? That's you. Your own car? That's you. Your insurance company owes you nothing. Worse, a lapse in coverage is a giant red flag to every insurance company in the country. When you go to get new insurance and they will see that lapse. They will label you a higher risk, and your rates will skyrocket. We're not talking about a 10% increase. We're talking about potentially doubling or tripling your premium for years to come. A single day of lapse coverage can cost you thousands of dollars over the long run. Set up automatic payments. Put a reminder in your calendar a month before it expires. Do whatever it takes, but never ever let your policy lapse. Now let's look at the section for covered autos, or listed vehicles. This part details the specific cars your policy is protecting. You'll see the year, make, model, and the vehicle identification number, or VIN for each car. The VIN is like a fingerprint for your car. No two are the same. Check it. Make sure it matches the VIN on your vehicle's dashboard and your registration. A simple typo here can create massive headaches during a claim. But there's something else here that most people ignore. The garaging address. This is the primary location where you park your vehicle, usually your home address. You might think, who cares where I park my car? Your insurance company cares. A lot. They use this address to determine your rating territory. Insurance rates are calculated down to the zip code, and sometimes even the specific neighborhood. They look at the statistics for that area. The number of accidents, the rate of vehicle theft, the cost of repairs, even the quality of the roads. Moving just 5 miles down the road from a quiet suburban zip code to a dense urban one can dramatically change your premium, because the statistical risk changes. This is why it's crucial to be honest about your garaging address. If you move, you must update your policy. Hiding the fact that you moved your car from a low-risk rural area to the middle of a major city to keep your old, lower rate is considered material misrepresentation. It's a form of fraud. And if you have an accident and the insurance company discovers you haven't been truthful about where the car is kept, guess what? They have grounds to deny your claim. They can say, we wouldn't have agreed to this contract at this price had we known the true risk. And just like that, you're on your own. This section is also where you can find clues about your coverage for a new car. Let's say you trade in your old sedan for a new truck. Are you covered the second you drive it off the lot? Almost always, yes. Most policies have a clause that gives you automatic coverage for newly acquired vehicles for a short period, usually 14 to 30 days. But, and this is a big but, it often only extends the exact same coverages you had on your old car. If you traded in a 15-year-old beater that only had basic liability, your brand new $60,000 truck might only have that same liability coverage until you officially add it to your policy. If you wreck it on the way home, the damage to your new truck itself might not be covered at all. The rule is simple. The very day you buy a new car, call your insurance company and get it properly added to your policy. Finally, on this first part of the page, you might see a line for a lien holder, or loss payee. This is another one of those jargon-y terms that confuses people, but it's really simple. If you have a loan or a lease on your car, the bank or finance company that lent you the money is the lien holder. They technically own a piece of your car until you pay it off. They are listed on your declaration page for one reason: to protect their investment. By being listed as the loss payee, they are legally entitled to be included on any check the insurance company issues if your car is totaled or stolen. This ensures that their loan gets paid off before you get a dime. It's also why they will almost certainly require you to carry specific coverages, which we'll get into. For now, just know that if you see a bank listed here, it's a reminder that you're not the sole owner of the vehicle just yet, and your insurance policy is protecting their interests as well as your own. We've just laid the groundwork. The who, the what, the when, and the where. This is the foundation of your policy, but we haven't even gotten to the heart of it yet. We haven't talked about the numbers, the dollar amounts, the coverage limits that can mean the difference between a minor inconvenience and total financial ruin. In the next part, we are going to dissect the most important coverage on your entire policy. This is the one that protects you from losing your home, your savings, and your future. We are talking about liability. This is the number one reason people go bankrupt after a car accident. And it has nothing to do with the value of their car. This is about protecting everything you own, and everything you will ever own from being taken from you in a lawsuit. Let's be crystal clear about what liability coverage is because most people get it wrong. Liability coverage is not for you. It does not pay to fix your car. It does not pay your medical bills. Liability coverage pays for the damage you cause to other people and their property. It is for them. So why is it the most important coverage for you? Because in the United States, if you are at fault in an accident, you are financially responsible for every penny of the damage you cause. And if your insurance isn't enough to cover it, the person you hit can sue you personally for the rest. They can take your savings. They can take your investments. They can put a lien on your house. They can garnish your wages for the next 20 years. Liability insurance is the financial shield that stands between a simple mistake on the road and the complete destruction of your life's work. Now grab your own declaration page. Find the section that says liability or bodily injury and property damage. You're going to see a set of numbers that look something like this: 25/50/25 or 50/100/50 or maybe 100/300/100. This isn't a secret code. It's the blueprint for your financial survival. And you need to understand what each of those numbers means. These are called split limits. Let's break them down using a common and terrifyingly low example: 25/50/25. The first number, the 25, stands for $25,000. This is the absolute maximum your insurance company will pay for bodily injury to any one single person you injure in an accident. That includes their medical bills, their lost wages, their pain and suffering. Everything. $25,000. Think about that. Have you seen a hospital bill lately? A single ambulance ride and an emergency room visit can easily cost more than $10,000. What if they need surgery? A single night in the hospital? Physical therapy for months? That $25,000 is gone before you can even blink. If you hit a person and their medical bills and lost wages total $80,000, your insurance pays the first $25,000. You personally are on the hook for the other $55,000. The second number, the 50, stands for $50,000. This is the absolute maximum your insurance company will pay for bodily injury in total for the entire accident, no matter how many people you injure. So, you run a red light and hit a car with 3 people in it. Person A has $20,000 in medical bills. Person B has $20,000. Person C has $20,000. The total medical cost is $60,000. Your policy has a $50,000 limit for the whole accident. That means even though no single person went over the $25,000 per person limit, your insurance still only pays out $50,000 total. The remaining $10,000? That's your bill. And that's a simple scenario. What if you hit a minivan carrying a family of 5? That $50,000 limit becomes a rounding error. The third number, the final 25, stands for $25,000. This is the maximum your insurance will pay for all property damage you cause in an accident. This is mostly for the other person's car, but it also includes anything else you damage. A mailbox, a storefront, a city light pole, a guardrail. $25,000. A decade ago, that might have been enough to replace the average car. But today, the average price of a new car in America is over $48,000. What if you hit a new Ford F-150? Or a Lexus? Or a Tesla with its complex electronics and battery pack? That $25,000 won't even cover half of it. What if you cause a multi-car pileup on the freeway? That $25,000 limit is supposed to cover every single car you damaged. It is laughably, dangerously inadequate. These low numbers, often called state minimums, are a trap. They make you legal to drive, but they leave you completely exposed financially. Let me tell you a story about a guy named David. David was 35, a software engineer, married with 1 kid, a homeowner. He was a good saver, putting money away for retirement in his daughter's college fund. He was a safe driver. To save about $30 a month, He kept his insurance at the state minimum 25/50/25. He thought, "I'm careful. It'll never happen to me." One rainy Tuesday morning, he was running late. He was stopped at a light, and he glanced down at his phone for just 2 seconds to check a notification. In that instant, his foot eased off the brake, and his car crept forward, tapping the bumper of the brand new Audi in front of him. It was a low-speed bump. No big deal, right? The driver of the Audi was a concert violinist. The tiny jolt was just enough to cause a severe wrist sprain and nerve damage in her bowing hand. Let's do the math on David's no-big-deal accident. First, the property damage. The Audi had a dozen sensors in its bumper that were damaged. The repair bill came to $11,000. David's $25,000 property damage limit covered this. He felt a wave of relief. But then came the bodily injury claim. The violinist couldn't perform for 6 months. She required specialized medical treatment, physical therapy, and consultations with top hand surgeons. Her medical bills totaled $40,000. Her lost income from canceled performances and orchestra contracts was over $200,000. Her total bodily injury claim was $240,000. David's policy had a bodily injury limit of $25,000 per person. His insurance company wrote a check for $25,000, and then they wished him luck. The violinist's attorney sued David personally for the remaining $215,000. David and his wife emptied their savings. They cashed out their investments. They took out a second mortgage on their home. They wiped out their daughter's college fund. For the next 15 years, a portion of David's paycheck was garnished to pay off the judgment. His 2-second glance at a phone, combined with the decision to save $30 a month, completely derailed his family's financial future. David's story isn't a one-in-a-million horror story. It happens every single day in this country. So what is the right amount of coverage? The state minimum is never the right answer. I want you to look at your liability limits as a shield for your assets. The more you have to lose, the stronger your shield needs to be. For most people, a good starting point is 100/300/100. That's $100,000 per person, $300,000 per accident for bodily injury, and $100,000 for property damage. This will cover you in the vast majority of accidents. A better, and increasingly necessary, standard is $250/500/100. That's $250,000 per person and $500,000 per accident. Why so high? Because if you cause a serious, life-altering injury, a lawsuit can easily reach $500,000 or more. This level of coverage is essential if you own a home or have any significant savings or investments. The cost to increase your limits from a low level to a much safer one is often shockingly small. We're talking about the price of a couple of lattes a month to protect yourself from a 6-figure lawsuit. It is the best money you will ever spend. There's one more thing you might see on some policies: a combined single limit, or CSL. Instead of split limits like 100/300/100, you might just see a single number like $300,000 or $500,000. This is a big, flexible pool of money that can be used for bodily injury or property damage in any combination, up to the limit. It's often a superior form of coverage. If you hit one person who has a $400,000 injury claim, a $500,000 CSL policy can cover it all. A $250/500/100 split limit policy would have capped that payout at $250,000 for that single person, leaving you on the hook for the rest. If you see a CSL option, it's definitely worth considering. The bottom line is this: liability coverage isn't about being a bad driver. It's about acknowledging that accidents happen to everyone. A moment of distraction, a patch of black ice, a deer jumping into the road, that's all it takes. You are not just insuring your 10-year-old car. You are insuring your home, your income, and your family's future. Don't be like David. Don't risk it all to save a few dollars. Okay, so we've built a strong financial fortress to protect ourselves in case we are at fault. But what happens when you're the victim? What happens when the person who hits you has that same terrible state minimum coverage? Or worse, no insurance at all? How do you pay for your medical bills and fix your car then? That's where our next section comes in. We're about to uncover the 2 coverages that protect you from the millions of irresponsible drivers out there on the road. Let's talk about the financial ghost that haunts every American highway. It's the driver in the car next to you with a canceled policy. It's the person who just ran a stop sign who let their insurance lapse 3 months ago. It's the 1 in 8 drivers in this country, and in some states as high as 1 in 4, who are operating a 2-ton metal projectile with absolutely zero insurance. When they crash into you, they don't just wreck your car. They vanish, leaving you holding a mountain of bills. This is not a rare event. It is a daily reality. And this is why the next section on your declaration page is, without exaggeration, one of the most critical forms of self-defense you can buy. Look for the lines that say uninsured motorist coverage, often abbreviated as UM. This coverage is your shield. It's you paying your own insurance company to step into the shoes of the at-fault driver who had nothing. It's your insurer paying you for the damage their phantom client should have paid for. And it's typically broken down into two vital parts. First, and most importantly, is uninsured motorist bodily injury, or UMBI. This is not for your car. This is for your body, your health, your ability to earn a living. Imagine a distracted driver blows through a red light and T-bones you in an intersection. Your leg is shattered, requiring multiple surgeries and months of physical therapy. You can't work your construction job for a year. The other driver gets out, says, "I'm so sorry." And then you find out they have no insurance. Who pays for that? Your health insurance might cover a portion of the hospital bills, after you meet your $5,000 deductible, of course. But what about the lost wages? What about the income you'll never get back while you recover? What about the permanent limp you now have, the chronic pain? What about compensating you for the sheer trauma and suffering of the event? Health insurance doesn't touch any of that. A lawsuit against the uninsured driver is pointless. You can't get blood from a stone. This is where uninsured motorist bodily injury saves you. It steps in and pays for your medical bills, your lost income, and your pain and suffering up to the limits you select. Just like your liability coverage, you'll see two numbers like 100/300. That means your policy would pay up to $100,000 for any single person's injuries, and a maximum of $300,000 for the entire accident if multiple people in your car are hurt. The second part is uninsured motorist property damage, or UMPD. This is the part that helps fix your car. If that same uninsured driver totals your $20,000 SUV, this coverage would pay to repair or replace it. Now you might be thinking, wait, I have collision coverage for that. And you're right. But UMPD often has a much lower deductible. Your collision deductible might be $1,000, but your UMPD deductible could be just $250. When you're not at fault, why should you have to pay a massive deductible because someone else was irresponsible? Using UMPD, if it's available in your state, can save you hundreds of dollars out of pocket right when you need it most. But the phantom driver isn't the only ghost on the road. There's a second, arguably more common threat. This is the driver who did the bare minimum. They bought the cheapest, weakest state-mandated insurance policy they could find, and it's about as useful as a screen door on a submarine in a serious accident. This brings us to the twin brother of uninsured motorist coverage, underinsured motorist coverage, or UIM. This protects you when the at-fault driver has insurance but just not enough. Let's run the numbers, because this is where the reality of awful insurance policies hits home. Let's say you're in that same accident, but this time the at-fault driver is a 20-year-old who has the California state minimum liability coverage of $15,000 for bodily injury. Your medical bills alone are $70,000, not to mention your lost wages and physical therapy. The other driver's insurance company will cut you a check for their policy limit, $15,000. That's all they are legally required to pay. That's it. You are still left with $55,000 in medical bills, plus all your other losses. You are financially ruined because someone else decided to save a few bucks a month. Unless you have underinsured motorist coverage, your UIM coverage swoops in to cover the difference. If you had a UIM limit of $100,000, it would pay the remaining $55,000 in medical bills and could provide another $45,000 for your lost wages and other damages. It fills the gap between the other driver's pathetic policy and your actual costs. It's the safety net below the safety net. So right now, I want you to look at your declaration page. Find the uninsured/underinsured motorist section. What are your limits? Are they the state minimum of $2,550? Or are they something more substantial like $100/300 or $250/500? Here is one of the most important pieces of advice you will ever receive about auto insurance. Your uninsured and underinsured motorist limits should, at a minimum, be an exact match to your own bodily injury liability limits. Think about the logic. Your liability limits represent the amount of damage you believe you could cause to someone else in a serious accident. If you've decided that you need $250,000 of coverage to protect your own assets in case you hurt someone else, Why on earth would you accept less than that to protect yourself and your family if someone does the exact same thing to you? You are essentially saying, I believe my family's health, well-being, and financial future are worth just as much as a stranger's. It is the most logical and powerful way to protect your own. And the cost? The cost to raise your UM/UIM limits from the state minimum to a truly protective level, like $250/500, is often shockingly small. We're talking about the price of a few cups of coffee a month. It is the single greatest bargain in the entire insurance industry. You are getting hundreds of thousands of dollars in personal protection for pennies on the dollar. Don't make the mistake of thinking your health insurance is enough. It won't pay your mortgage when you can't work. It won't help your kids with their college fund when your income disappears. And it won't do a single thing for your passengers who might not have any health insurance at all. These coverages aren't just ink on a page. They are a firewall between your family and financial catastrophe caused by someone else's recklessness. They ensure that your life isn't derailed because the person who hit you was either irresponsible or just plain broke. So we've established how to shield yourself from the financial fallout caused by other drivers. But accidents aren't always that clear-cut. What about your own medical bills regardless of who is at fault? What if you're the one who swerves to miss a deer and hits a tree? Who pays then? There's another layer of protection, a type of no-fault coverage designed to pay your medical expenses immediately, without waiting for lawyers or fault to be determined. It's your financial first aid kit, and for many, it's a non-negotiable part of a rock-solid policy. But what happens when that first aid kit isn't for you? What happens when the person who just T-boned you at an intersection is the one who desperately needs financial help, but doesn't have a single penny of insurance to their name? Suddenly, your protection isn't just about your own mistakes. It's about defending yourself from the financial irresponsibility of others. This brings us to one of the most critically misunderstood, and arguably most important, sections on your declaration page: uninsured and underinsured motorist coverage. Look closely at your deck page now. You're searching for the abbreviations UM and UIM. Find them, because these two lines could be the only thing standing between you and absolute financial ruin. Let's paint a picture. You're driving home on a Friday afternoon. The light turns green, you proceed through the intersection and BAM. A speeding car runs the red light and plows directly into your driver's side door. Airbags deploy, glass shatters, and your world is a chaotic mess of screeching metal and smoke. After the shock subsides, you realize you're hurt. Your arm is broken, your neck is in searing pain. The other driver miraculously is walking around, but they have a panicked look on their face. The police arrive, and you overhear the conversation. The other driver whispers, "I don't have insurance. I let it lapse." In that moment, a tidal wave of dread washes over you. Who is going to pay for this? Your $100,000 hospital bill? The weeks, maybe months of lost wages from your job? The physical therapy you'll need to learn to walk without a limp? The other driver is at fault. But what does fault even mean when the person at fault has no money and no insurance? Suing them is like trying to squeeze water from a stone. They have nothing to give. This is not a rare, one-in-a-million scenario. The Insurance Research Council estimates that 1 in every 8 drivers on the road in the United States is uninsured. 1 in 8. That means on your average commute, you will pass dozens, if not hundreds, of drivers who are rolling financial time bombs, ready to detonate your life savings with one bad decision. This is where your uninsured motorist coverage, or UM, rides in like the cavalry. It is insurance you buy for yourself to protect you from the uninsured. It's a paradox, isn't it? You have to insure yourself against people who break the law by not having insurance. Now, look at your declaration page again at that UM section. It's typically broken down into 2 critical parts: uninsured motorist bodily injury, UMBI, and uninsured motorist property damage, UMPD. UMBI is for you. It's for your passengers. It's for your family. It pays for the exact things we just talked about: your medical bills, your ambulance ride, your lost income, and yes, even for pain and suffering. It steps into the shoes of the at-fault driver's insurance that should have existed, and it pays you. On your deck page, you'll likely see this written with split limits, just like your liability coverage. It might say 100/300. That means your policy will pay up to $100,000 for any single person's injuries in your car, and up to a maximum of $300,000 for the entire accident if multiple people are hurt. Then there's UMPD, uninsured motorist property damage. This coverage is specifically to repair or replace your car if it's damaged by an uninsured driver. Now you might be thinking, wait, don't I have collision coverage for that? And you're right, you might. But using your UMPD coverage often comes with a much lower deductible than your collision coverage, sometimes as low as $100 or $250. It's a cheaper, better way to get your car fixed when the accident wasn't your fault, but the other person can't pay. However, be aware, UMPD is not available in every state, and some states require you to identify the at-fault driver for it to apply, which can be a nightmare in a hit-and-run situation. But let's complicate our story a bit. What if the driver who hit you wasn't completely uninsured? What if they had insurance, but it was the absolute bare minimum policy required by law? Imagine the same accident. This time, the at-fault driver proudly shows the officer an insurance card. You feel a momentary sense of relief, but then you discover their policy only has a $25,000 bodily injury liability limit. That's it. Meanwhile, your initial hospital bill alone is $80,000. Not to mention the ongoing surgeries and therapy you'll need. Their insurance company will write you a check for $25,000, and then legally, they can wash their hands of the situation. They've fulfilled their obligation. So where does the other $55,000 and all future costs come from? You're left holding the bag for a massive financial deficit, all because someone else chose to buy the cheapest, most inadequate plan possible. This is where the second hero of our story appears. Underinsured motorist coverage, or UIM. This is arguably even more important than because the number of underinsured drivers is vastly higher than the number of uninsured. UIM coverage is designed to fill the gap. It kicks in when the at-fault driver's liability limits are exhausted and are not enough to cover your damages. In our example, after you receive the $25,000 from the other driver's insurance, you would then file a claim with your own insurance company under your UIM policy. If you had, say, $250,000 in UIM coverage, your policy could pay the remaining $55,000 of your medical bills and would still have nearly $200,000 left to cover your lost wages and future needs. It is your ultimate safety net. So I ask you again, look at your declaration page. Find the lines for UM and UIM. What are your limits? Many people, in an effort to save a few dollars a month, will carry the state minimums for themselves, maybe $25.50. They have more insurance on their iPhone than they do on their own body and their ability to earn a living. You must understand this. You should never have lower UM/UIM limits than you have bodily injury liability limits. You are essentially saying, I believe I should be held responsible for up to $250,000 if I hurt someone else, but if someone else hurts me, I'm only worth $25,000. It makes no logical sense. Your UM/UIM coverage is a direct investment in your own well-being. It is you betting on yourself. Now, for a pro-level tip that your agent may have never explained. Look at your policy details. Do you see the word stacking or stacked? In many states, if you have multiple vehicles on your policy, you can stack your UM/UIM coverage. Let's say you have 2 cars, and each one has 100/300 in UM coverage. If you have a non-stack policy, your limit is just 100/300, no matter which car you're in. But if you pay a slightly higher premium for a stacked policy, you can combine those limits. Suddenly, you have a massive $200,000 per person, $600,000 per accident safety net. It multiplies your protection. If stacking is available in your state, it is one of the single most powerful ways to fortify your financial future for a relatively small cost. When you look at that premium for uninsured and underinsured motorist coverage on your declaration page, don't see it as an expense. See it as a shield. It's a shield that protects you from the 12% of drivers with no insurance, and the perhaps 30 or 40% more who have so little insurance it might as well be none at all. It protects your health, your family, your income, and your future from being destroyed by someone else's mistake. It is the single most important coverage you can buy for yourself, period. We've now built a fortress to protect you from the financial fallout caused by other drivers. But what about your own vehicle? What happens when a tree falls on it in your driveway? Or you swerve to miss a deer and hit a guardrail? In those moments, fault is irrelevant. What matters is the specific coverage designed to repair or replace your most valuable asset. And that's exactly what we're breaking down next. Let's talk about the 2 coverages that are all about you. They're about your car, your investment, your peace of mind. These are the coverages that step in when the question isn't whose fault was it, but how do we fix this? We're talking about collision and comprehensive. Think of them as 2 different bodyguards for your car. First up is collision coverage. The name says it all. This is for when your vehicle collides with something. It could be another car, a telephone pole, a fence, a guardrail, even the curb in a parking lot. Collision is also what covers you if your car is hit while it's parked, or if you flip your car in an accident. If your car is in motion and makes contact with an object, or is hit by another moving object, collision is your go-to. Now let me paint a picture. You're at the grocery store on a busy Saturday. You're backing out of a tight spot, you're checking your mirrors, you're looking at your backup camera, but you misjudge it. You hear that sickening, gut-wrenching crunch of metal on metal. You've just backed into a brand new pickup truck. Your bumper is toast. It's 100% your fault. You feel that hot flush of embarrassment and dread. Without collision coverage, you're on your own for your car's repairs. You'd have to pay the body shop thousands of dollars out of your own pocket. But with collision coverage, you take a deep breath, you call your insurance company, and you start a claim. And this is where we need to talk about a critical word on your declaration page: the deductible. Your deductible is the amount of money you have agreed to pay out of pocket for a repair before your insurance company starts paying. It's your share of the cost. So let's say the damage to your car is $4,000, and you have a $500 collision deductible. You pay the first $500 to the body shop, and your insurance company pays the remaining $3,500. This is one of the most important choices you make on your policy. A lower deductible, say $250, feels great when you have a claim, but you pay for that privilege every single month with a higher premium. A higher deductible, maybe $1,000 or even $2,000, will lower your monthly premium significantly. But you have to be honest with yourself. Could you write a check for that amount tomorrow if you had to? Choosing your deductible is a personal risk calculation. It's a bet you're making with yourself. Do you want to pay a little more consistently to have less pain later, or save money every month and risk a bigger one-time hit? There's no right answer, only the answer that's right for your financial situation. Now let's talk about the second bodyguard: comprehensive coverage. The official name is actually other than collision coverage, which is a perfect description. This is the coverage for almost everything else that can damage your car. It's for the bizarre, the unpredictable, the acts of God, and the acts of criminals. Comprehensive covers theft. You walk out in the morning and your car is just gone. It covers vandalism. Someone keys your paint job or smashes your windows. It covers fire, floods, and earthquakes. It covers falling objects, a tree branch in a windstorm, a chunk of ice off a building, or that nightmare scenario of something flying off a truck on the highway and smashing into your windshield. And crucially, it covers hitting an animal. Remember that deer we talked about? You swerved to miss it and hit a guardrail, that's a collision claim. But if you can't swerve and you hit the deer, that is a comprehensive claim. It's a strange distinction, but it's a critical one. Let's imagine another scenario. A massive hailstorm rolls through your town without warning. For 10 minutes, golf ball-sized chunks of ice pummel your neighborhood. When it's over, you look outside and your car's hood, roof, and trunk look like the surface of the moon. It's devastating, but it wasn't a collision. You weren't at fault. It was just bad luck. This is exactly what comprehensive coverage was designed for. Just like collision, comprehensive has its own deductible. And here's something most people miss. Your comprehensive deductible does not have to be the same as your collision deductible. You can have a $500 deductible for collision and a separate, maybe lower $100 deductible for comprehensive, which is common for glass replacement. Or maybe you live in an area with low crime and good weather, so you opt for a higher comprehensive deductible to save money. You can customize them. Look at your declaration page right now. Do you have two different deductibles listed? Now you know why. Now I need to take a moment to debunk one of the most dangerous and misleading phrases in the entire insurance world: full coverage. You will not find the term full coverage anywhere on your actual policy documents. It does not exist. It's a slang term, a shorthand that people use, and it creates a massive false sense of security. Generally, when people say full coverage, they mean a policy that includes liability, collision, and comprehensive. But does that sound full to you? What about covering the cost of a rental car while yours is in the shop for 2 weeks? That's a separate coverage. What about roadside assistance if you get a flat tire? Separate coverage. What about coverage for the custom $2,500 rims you put on your car? That's probably a separate endorsement too. Believing you have full coverage can lead to devastating surprises. You assume you're protected against everything, only to find out you're not when you need it most. So strike that phrase from your vocabulary. Instead, know the names of your specific coverages. That's why we're going through this line by line. Knowledge, not slang, is power. So if collision and comprehensive are so important, why doesn't everyone have them? Well, if you own your car outright, you have the title, no loans, the choice is yours. But for the millions of Americans who have a car loan or a lease, the choice is made for them. Your lender, the bank or credit union that financed your car, has a vested interest in that vehicle. Until you make that final payment, the car is their collateral. It's the security for their loan. If you total the car and don't have insurance to fix or replace it, you might just stop paying them. And they're left with nothing. So they require you. It's a non-negotiable part of your loan agreement to maintain both collision and comprehensive coverage with a deductible that's usually capped at a certain amount, often $1,000. They are protecting their asset. The moment you pay off that loan and get the title in your name, you'll get a letter from them saying you're no longer required to carry these coverages. And that leads to the million-dollar question: when should you drop them? Your car gets older. Its value depreciates. At some point, the cost of paying for collision and comprehensive coverage every year might not be worth the potential payout you'd get. Here's a simple framework to help you decide. First, find the actual cash value or ACV of your car. That's what it's worth today, not what you paid for it. You can get a good estimate from sites like Kelley Blue Book or Edmunds. Let's say your 12-year-old sedan is worth $3,000. Next, look at your declaration page and find out how much you're paying per year for just the collision and comprehensive portions of your premium. Let's say it's $600 a year. Now do the math. You're paying $600 a year to protect a $3,000 asset. That's 20% of the car's value every single year. If you have a $500 deductible, the absolute maximum your insurance company would ever pay you is $2,500. Is it worth it? Maybe not. You could take that $600 a year and put it into a savings account. In a few years, you'd have enough to buy a similar used car if yours was totaled. This is called self-insuring. But, and this is the most important part, you should only do this if you can truly afford to walk away from the value of your car tomorrow. If that $3,000 car is your only way to get to work, and you don't have savings to replace it, then paying that $600 a year for protection might be the smartest money you ever spend. Collision and comprehensive are about protecting your property from the predictable crunch of an accident and the unpredictable chaos of the world. They ensure that a physical loss doesn't become a total financial catastrophe. But we've just covered how to protect yourself and your assets. We've covered how to protect your car. There's still a terrifying gap. What happens when the person who hits you did none of this? What happens when they have no insurance or so little it's basically useless? You could be left with crippling medical bills and no way to pay them. Even when the accident wasn't your fault at all. You're relying on their responsibility, and that's a gamble you can't afford to take. So how do you protect yourself from the uninsured? That's what we're untangling next. This is where your auto policy transforms from a shield that protects others into a suit of armor that protects you. It's called uninsured and underinsured motorist coverage, and it is, without a doubt, one of the most critical and misunderstood lines on your entire declaration page. Let's break it down piece by piece. First, you have uninsured motorist bodily injury, or UMBI. This is your personal bodyguard. Imagine you're driving home from work, stopped at a red light. Suddenly, bam, you're rear-ended by a driver who was texting. The impact is severe. Your car is a wreck and you have a serious neck injury and a broken wrist. The other driver gets out, panics when they realize what they've done, and speeds off. A classic hit and run. You're left on the side of the road with flashing lights, an ambulance ride, and the start of a very long, very painful, and very expensive recovery. You'll need x-rays, a cast, months of physical therapy, and you can't work your construction job with a broken wrist. The paychecks stop, but the bills don't. Who pays for this nightmare? The driver who hit you is a ghost. They vanished. In the eyes of your insurance company, a hit-and-run driver is treated as an uninsured driver. This is where your UMBI coverage kicks in. It steps into the shoes of the phantom driver who hurt you. Your own insurance company will pay for your medical bills, your lost wages while you recover, and this is the crucial part, for your pain and suffering. Your health insurance will never pay you for lost income. It will never compensate you for the agony of recovery, the missed family events, or the chronic pain you might have to live with. UMBI does. It's designed to make you whole again, financially and physically, when someone else's irresponsibility shatters your life. Now look at your declaration page. You'll see UMBI limits, often written just like your liability limits. Something like 100/300. That means your policy will pay up to $100,000 for your injuries, and up to a total of $300,000 for everyone injured in your car. Here's the key piece of advice every insurance professional will give you. Your uninsured motorist limits should, at a minimum, match your bodily injury liability limits. Think about what it means if they don't. If you have 250/500 liability, you're saying, if I hurt someone, I believe their life and livelihood is worth up to $250,000. But if you only have 2550 for your own uninsured motorist coverage, you're telling the insurance company, if someone hurts me, I think my own life and livelihood is only worth $25,000. You are valuing a stranger's well-being 10 times more than your own. It makes no sense. You are worth protecting just as much as you're willing to protect others. Match those limits. But what if the driver doesn't flee? What if they stay there apologetic and they have insurance? It's just terrible insurance. This is an even more common scenario, and it's where the second part of your armor comes in. Underinsured motorist bodily injury, or UMBI. Let's change the story. This time you're driving through an intersection on a green light, and another driver runs their red light, T-boning your car. It's a devastating crash. You're hospitalized with internal injuries and require surgery. Your medical bills quickly soar past $150,000. You'll be out of work for at least a year. The other driver is clearly at fault. The police report says so, and they have insurance. The problem? They only have the state minimum liability coverage of $25,000. Their insurance company does what it's supposed to do. It investigates, sees its driver is 100% at fault, and promptly sends you a check for their policy limit, $25,000. And that's it. Their legal obligation is fulfilled. They are done. You're left holding a bill for $150,000, and you've only received $25,000. You are still in a $125,000 hole, and that doesn't even account for the year of lost income or the permanent physical damage you've suffered. You can try to sue the at-fault driver personally, but the vast majority of people with minimum limits insurance have no assets to go after. You can't get blood from a stone. You are financially ruined because someone else made a bad decision. Unless you have underinsured motorist coverage, UMBI is the hero that bridges the gap. Once you've received the maximum payout from the other driver's policy, you can then file a claim with your own insurance company under your UIMBI coverage. If you have a $250,000 UIMBI limit, your policy can pay the difference between your total damages and the $25,000 you already received. It can cover the rest of your medical bills, your massive loss of income, and your pain and suffering all the way up to your policy limit. It's the ultimate safety net. It protects you from the millions of drivers who are technically insured, but are functionally uninsured for any serious accident. These two coverages, UMBI and UIMBI, are about protecting your body, your health, and your ability to earn a living. But what about your car? If an uninsured driver totals your $40,000 truck, you're not just hurt, you're without a vehicle. There are two ways your policy can address this. The first is uninsured motorist property damage, or UMPD. This coverage specifically pays to repair or replace your car if it's damaged by a known, confirmed, uninsured driver. The problem is it often has a low limit, sometimes as low as a few $1,000s, and in many states it doesn't apply to hit-and-run accidents. If you can't identify the driver, you can't use the coverage. This makes UMPD a weak and unreliable solution. The far superior, bulletproof solution is collision coverage. We'll do a deep dive on collision and comprehensive later, but for this specific problem, it's the answer. Collision coverage pays to fix your car regardless of who is at fault. If an uninsured driver hits you and flees, collision pays. If an uninsured driver hits you and stays, collision pays. If a meteor falls from the sky and hits your car, well, that's not collision, but you get the point. Collision coverage doesn't care about the other driver's insurance status. It just cares that your car is damaged. You'll have to pay a deductible, yes. But here's a pro tip. Many insurance companies will actually waive your collision deductible if you're hit by an uninsured driver that you can positively identify. You get all the benefits of a comprehensive repair without the unreliability of UMPD, and without paying a cent out of pocket. For this reason, many people choose to carry high levels of UMBI/UIMBI for their health, and a good collision policy with a manageable deductible for their vehicle, and they decline the UMPD coverage altogether. Look at your policy. Find these lines. Don't just glance at them. Understand that these numbers represent the financial wall standing between your family and utter devastation caused by someone you've never met. This isn't just insurance. It's a declaration of your own self-worth. It's the proactive choice to protect your future from the gamble of another person's irresponsibility. So now you're protected from the uninsured and the underinsured. But what about the immediate aftermath of an accident? Before fault is even determined, the ambulance isn't free, and the emergency room sends a bill the next day. Who pays for that right now with no questions asked? There's a section on your policy designed for exactly this. It's your first responder coverage, and for many, it's the most misunderstood part of the entire page. It's called medical payments coverage, or MedPay for short. In some states, it's a more powerful version called personal injury protection, or PIP, and its job is simple: to pay for medical treatment for you and your passengers immediately after an accident, no matter who was at fault. Let me say that again because it's the most important part. No matter who was at fault. This is the fundamental difference between this coverage and the liability coverage we talked about earlier. Liability is about a long, slow argument over who was wrong. It's about investigations, police reports, and adjusters debating percentages of fault. That can take weeks, sometimes months. But a hospital bill doesn't wait for a verdict. An ambulance company doesn't care about the other driver's story. They want to be paid, and they want to be paid now. MedPay is your financial first responder. It's the coverage that steps in and says, don't worry about the blame game. Let's get these bills paid so you can focus on recovering. Let's walk through a classic scenario. You're at a four-way stop. You do everything right, but the driver to your left gets distracted and rolls right into your passenger side. It's not a huge crash, but it's a solid jolt. You and your passenger feel okay, a little shaken up, but you decide to go to the emergency room just to be safe. You get checked out, maybe get an X-ray. The doctor says you have some minor whiplash and to take it easy. A week later, you each get a bill for $1,000. Who pays? Without MedPay, you're in a tough spot. You could pay it out of pocket and hope the other driver's insurance reimburses you eventually. You could try to bill your own health insurance, which we'll talk about in a second. Or you could wait, letting that bill sit there while the insurance companies figure things out. But if you have MedPay, the process is beautiful in its simplicity. You submit the ER bill to your own insurance company under your MedPay coverage. They look at it, see it's a valid medical expense from the accident, and they cut a check. That's it. The bill is paid. There's no deductible. There's no argument. It doesn't matter that the other driver was 100% at fault. Your coverage takes care of you right now, and it doesn't just cover you. It covers anyone who was in your car. It even covers you if you're not in your car at all. If you're walking through a parking lot and get hit by a car, or if you're riding your bike and a driver clips you, your own auto insurance policy's MedPay can step in to cover your medical bills. Now look at your declaration page. You'll see medical payments and a dollar amount next to it. This is typically shown as a per-person limit. Common amounts are $1,000, $5,000, or $10,000. This is the maximum amount your policy will pay for any single person's medical bills in an accident. So if you have a $5,000 limit, and you and a passenger are both injured, your policy can pay up to $5,000 for your bills, and up to $5,000 for your passenger's bills. And this is where I hear the biggest objection. But I have great health insurance. Why would I need MedPay? It's a fair question, but it misses a few critical points. First, your health insurance has a deductible. For many people, that deductible is thousands of dollars. If you have a $5,000 health insurance deductible, that ER visit we just talked about is coming straight out of your bank account. But if you have $5,000 in MedPay, you can use that to pay the bill. Your MedPay coverage can literally pay your health insurance deductible for you. It acts as the first line of defense, protecting your savings. Second, health insurance has copays and coinsurance. Even after you meet your deductible, you might still be responsible for 20% of the bill. Again, MedPay can step in and cover those costs for you. And third, and this is the most alarming one, some health insurance policies have specific exclusions for injuries sustained in an auto accident. They might state that auto insurance must be the primary payer. If you've waived MedPay on your auto policy, you could find yourself in a horrifying catch-22 where your auto policy won't pay because you waived the coverage, and your health policy won't pay because they say the auto policy should have. Having MedPay eliminates this risk entirely. Now, for those of you living in what are called no-fault states, places like Florida, Michigan, New York, and several others, you'll see something different on your declaration page. You'll see personal injury protection, or PIP. Think of PIP as MedPay's bigger, stronger sibling. Like MedPay, it covers your medical bills regardless of who was at fault. But it doesn't stop there. This is the game changer. PIP also covers other economic losses that MedPay doesn't touch. The biggest one is lost wages. Let's go back to that accident, but this time it's more serious. You have a broken arm and you can't do your job for a month. The medical bills are piling up, but now you have an even bigger problem. Your paychecks have stopped. How do you pay your mortgage? How do you buy groceries? This is how a physical crisis quickly becomes a full-blown financial catastrophe. This is where PIP becomes your lifeline. In addition to paying your doctor and hospital bills, PIP can reimburse you for a percentage, often up to 80%, of your lost income while you're recovering. It keeps your household running when you physically can't. But it gets even better. PIP can also cover what's called essential services. Let's say you're a stay-at-home parent and you're injured in a crash. You don't have lost wages, but you can no longer take care of your children or manage your home. PIP can pay for replacement services, like hiring someone for childcare or house cleaning while you recover. It recognizes that the work you do has real, tangible economic value. In a no-fault state, the law says that instead of suing the other driver for your injuries, you first turn to your own PIP coverage. The idea is to get money into the hands of injured people faster and keep smaller claims out of the court system. When you look at PIP on your declaration page, you'll see it's more complex than MedPay. You'll have an overall limit, which can be much higher, $25,000, $50,000, or even more. You might also have a deductible, which is an amount you have to pay first before the PIP coverage kicks in. You may also have options to coordinate your PIP with your health insurance, which can lower your premium but requires your health insurance to pay first for medical bills. So, how do you choose the right amount? If you have MedPay, a good rule of thumb is to select a limit that is at least as high as your health insurance deductible. If your deductible is $2,500, having at least that much in MedPay ensures that a minor accident doesn't cost you a dime out of pocket for medical care. And when you see how inexpensive it is to raise that limit from $1,000 to $5,000, you'll realize it's one of the best bargains in insurance. If you have PIP, the calculation is more involved. You need to think about your what-if number. What if you were unable to work for 2 months? Look at your monthly income. Look at your sick leave and disability benefits from your employer. How big is the gap? Your PIP limit should be high enough to bridge that gap and cover any potential medical bills on top of it. Don't just pick the state minimum because it's the cheapest. The state minimum is designed to be the absolute bare minimum, not what an average family actually needs to survive a crisis. This part of your policy is profoundly important. It's the part that protects you, your family, and your financial stability in the immediate, chaotic aftermath of an accident. It's the money that lets you say yes to the ambulance, yes to the ER visit, and yes to the follow-up care, without having to first check your bank account. You've now taken care of your car with collision and comprehensive. You've taken care of your legal responsibility to others with liability. And you've just taken care of your own immediate medical needs with MedPay or PIP. You've built a formidable fortress of protection around yourself. But there's a crack in the wall. A massive one. What happens when the person who hits you has no insurance at all? Or they have the bare minimum state limit that gets exhausted after the first night in the hospital? You did everything right. You bought the right coverage. But someone else's irresponsibility is about to cost you everything. Your fortress is about to be overrun. Or is it? There's a shield on your policy designed for exactly this nightmare scenario. And it's the last piece of the puzzle in protecting yourself. This shield is called uninsured and underinsured motorist coverage. And it is, without a doubt, one of the most misunderstood, yet most critically important coverages you can have. It's not about protecting others from you. It's not even about protecting you from an accident that's your fault. This is the one coverage that protects you from the financial irresponsibility of a complete stranger. It's a policy you buy on other people. Let's break it down. Uninsured motorist coverage protects you if you're hit by someone with no insurance at all. Underinsured motorist coverage protects you if you're hit by someone whose insurance isn't enough to cover your damages. They sound similar, but that small difference can be the deciding factor between recovery and ruin. To understand its power, you have to walk through the nightmare. Imagine you're driving home from work. You're a safe driver. You followed every piece of advice we've talked about. Your liability limits are high, you have solid medical payments coverage, you've done everything right. You're stopped at a red light, listening to the radio, thinking about what's for dinner. Suddenly, an explosion of sound and force. A speeding truck, running the red light, plows directly into your driver's side door. The world goes black. You wake up in a hospital. The doctors tell you you're lucky to be alive. You have a shattered pelvis, 3 broken ribs, and a severe concussion. The road to recovery will be long, painful, and paved with endless physical therapy appointments. Your car, the one you just finished paying off, is a twisted wreck, a total loss. The police report is crystal clear. The other driver was 100% at fault. They were texting and driving, and blew through the intersection at 50 miles per hour. A wave of relief washes over you. At least you won't have to pay for this. Their insurance will cover it all. But then your agent calls with the news that makes your blood run cold. The other driver didn't have insurance. Not a single dollar. They let their policy lapse months ago. Suddenly, the entire financial weight of this catastrophe shifts from their shoulders directly onto yours. Your personal injury protection or medical payments coverage, that $25,000 you had, is gone in the first few days of your hospital stay. It's a drop in the ocean. Your health insurance kicks in, but you're still on the hook for a $10,000 deductible and 20% co-insurance on bills that are already soaring past $200,000. You can't work. Your lost income starts piling up. You're losing thousands of dollars a week with no end in sight. You could sue the other driver personally, of course. But what are you going to get? They have no insurance because they have no money. You can win a lawsuit and $1 million judgment. But a piece of paper is worthless if the person you're suing has no assets to seize. You can't get blood from a stone. This is it. This is the moment where responsible people who did everything right, are forced into bankruptcy. They lose their homes. Their savings are wiped out. Their lives are permanently derailed, not because of their own mistake, but because they had the horrific bad luck to cross paths with someone who didn't care. But you have the shield. You have uninsured motorist bodily injury coverage. You call your insurance company and declare a claim under your own policy. And here's what happens. Your insurance company, the one you've been paying every month, steps into the shoes of the uninsured at-fault driver. They effectively become the insurance company for the person who hit you. Your uninsured motorist coverage starts paying for what the other driver's liability insurance should have paid for. It covers your massive medical bills beyond what your PIP or health insurance covered. It pays for your lost wages while you're recovering. And critically, it pays for your pain and suffering, the non-economic damages for the trauma, the permanent limp you might have, the chronic pain you'll endure for the rest of your life. Things your health insurance would never ever touch. If you had $250,000 of uninsured motorist bodily injury coverage, that's the fund you now have access to. It's your financial lifeline. It's the shield that stands between you and absolute devastation. Now let's rewind the scenario just a little. What if the driver who hit you wasn't uninsured but underinsured? Let's say they did the bare minimum. They carried their state's required liability limit of, say, $25,000. That $25,000 is paid out to you almost immediately. But your medical bills alone are $200,000. Your lost wages are another $50,000. That $25,000 is a joke. It's an insult. It's gone before you even leave the hospital. There's a massive $225,000 gap between what their insurance paid and what you've actually lost. This is where underinsured motorist coverage saves the day. Once their tiny policy limit is exhausted, your own underinsured coverage kicks in to cover the difference, up to your policy limit. So if you have $250,000 in underinsured motorist coverage, your policy can pay you the remaining $225,000 you're owed. It fills the gap that the irresponsible driver left behind. You might be thinking, what are the odds of this really happening? The odds are terrifyingly high. The Insurance Research Council estimates that 1 in 8 drivers on the road in the United States is uninsured. That's nearly 13% of everyone you share the road with. In some states, it's far worse. In Mississippi, it's almost 30%. In Florida, Michigan, and Tennessee, it's over 20%. That means in some places, 1 out of every 4 or 5 cars that passes you could have no insurance at all, turning a simple fender bender into a potential financial crisis. This is why the single most important rule of thumb when choosing your limits is this. Your uninsured and underinsured motorist coverage limits should always match your own bodily injury liability limits. If you have decided that you need $250,000 of liability coverage to protect your own assets from a lawsuit, why on earth would you accept less than that to protect your assets and your health from someone else's negligence? You are betting on the responsibility of every single stranger on the road if your limits don't match. That is a terrible bet to make. So I want you to pull out your declaration page right now. Find the section for uninsured/underinsured motorist, often abbreviated as UM/UIM. Look at those numbers. Do they match the bodily injury liability limits we talked about in the last part? If they don't, you have a major vulnerability in your armor. And look for one more crucial term: stacking or non-stacking. This is an option in many states. Non-stacking means the limit you see is the absolute max you can get. If you have $100,000 in coverage, that's it. But stacking allows you to combine the UM/UIM coverage from multiple vehicles on your policy. If you have 2 cars, each with $100,000 of stacked coverage, you can potentially stack them to have $200,000 of coverage available for a single accident. It costs a little more, but it dramatically increases your protection. If your policy says non-stacking or you rejected stacking, you need to understand you are leaving a powerful tool on the table. This coverage isn't a luxury. It's a non-negotiable necessity in modern driving. You cannot control what other people do. You can't force them to buy insurance. You can't stop them from texting or drinking or driving recklessly. The only thing you can control is your own preparation. The only thing you can do is build a shield that is strong enough to withstand the financial fallout from their actions. We've now built the core of your financial fortress. We've erected the outer walls with high liability limits to protect you from others. We've stocked the medical bay with PIP and MedPay for immediate care. And now we've raised the final gleaming shield of UM/UIM to protect you from the uninsured hordes. Your defense against catastrophic loss is complete. But what about the fortress itself? What about the vehicle you rely on every single day? An accident doesn't have to be catastrophic to be expensive. What happens when a tree falls on your car? Or a thief smashes your window? Or you simply back into a pole in a parking lot? These everyday events aren't covered by anything we've discussed so far. And they can still leave you with thousands of dollars in bills and no way to get to work. Your fortress is secure, but the castle keep itself is still vulnerable. That's where the final and perhaps most familiar pieces of your auto insurance policy come into play: collision and comprehensive coverage. These are the coverages that actually fix or replace your car. Think of them as the armor plating on your vehicle. Let's start with collision. The name says it all. This covers damage to your car from a collision with another object, whether that's another vehicle, a guardrail, a telephone pole, or even a pothole that causes you to lose control and hit a curb. It also covers you if your car flips over. Critically, collision coverage pays out regardless of who is at fault. If you cause the accident, your liability coverage pays for the other person's damages, and your collision coverage pays for your own. If the other person is at fault but they're uninsured, your uninsured motorist property damage might kick in, or your collision coverage will. Your insurance company will then go after the at-fault driver to get their money back, a process called subrogation, but you don't have to wait for that. You get your car fixed now. Now, with collision coverage comes a very important number on your declaration page: your deductible. The deductible is the amount of money you have to pay out of your own pocket for a claim before the insurance company starts paying. It's your share of the risk. Common deductibles are $500, $1,000, or even $2,500. Let's say you have a $1,000 deductible. You swerve to avoid a squirrel and hit a mailbox, causing $6,000 in damage to your car. You will pay the first $1,000 to the body shop, and your insurance company will pay the remaining $5,000. A higher deductible means a lower premium, because you're agreeing to take on more financial risk yourself. A lower deductible means a higher premium, because the insurance company is on the hook for more. The absolute golden rule here is to never, ever choose a deductible that you couldn't afford to pay in cash tomorrow. If you have a $1,000 deductible but only $200 in your savings account, you've set yourself up for a financial disaster. Next to collision on your deck page, you'll see its partner, comprehensive coverage, which is sometimes called other than collision. This is the coverage for almost everything else that can happen to your car that isn't a direct collision. This is the acts of God and bad luck coverage. A hailstorm turns your car's roof into a golf ball? That's comprehensive. A deer decides to use your front grille as a shortcut? Comprehensive. A tree branch falls on your hood during a windstorm? Comprehensive. Vandals key your paint job, a thief steals your catalytic converter, or someone steals the entire car. All comprehensive claims. Fire, flood, earthquakes, it's all covered here. Just like collision, comprehensive coverage has its own deductible, which you can often set at a different amount. Maybe you're a great driver and not worried about a collision, so you have a high collision deductible, but you live in an area with a lot of deer and hail, so you opt for a lower comprehensive deductible. When people use the term full coverage, This is usually what they mean, having the state-required liability plus collision and comprehensive. But full coverage is a myth. It's a slang term, not an insurance term, and it can give you a dangerous false sense of security. Because even with this holy trinity of coverages, your fortress is still missing some critical defenses. This is where we enter the final section of your declaration page. The endorsements. These are the optional add-ons, the special ops soldiers of your policy that handle very specific and very common problems. One of the most important is rental reimbursement. If you get into a covered accident and your car is in the shop for 2 weeks, how do you get to work? How do you take your kids to school? Without this coverage, you're paying for a rental car out of your own pocket. At $40, $50, or $60 a day, that can add up to over $1,000 before you get your car back. Rental reimbursement coverage, which often costs just a few dollars a month, will pay for that rental car up to a certain daily limit, like $50 a day, for a maximum of 30 days. It's an incredibly cheap way to guarantee you won't be stranded. Next, you might see towing and labor or roadside assistance. This is another inexpensive add-on that can be a lifesaver. It covers the cost of a tow to the nearest repair shop if your car breaks down. It can also cover things like changing a flat tire, jump-starting a dead battery, or even bringing you a few gallons of gas if you run out. One single tow can cost over $100. This coverage might cost you $10 or $20 for the entire year. It's a no-brainer. Now for a huge one, especially if you have a loan or a lease on your car. Gap insurance. This is one of the most misunderstood but financially crucial coverages you can buy. When you drive a new car off the lot, it depreciates in value instantly. Your insurance company will only ever pay you what your car is worth at the moment it's totaled. This is called its actual cash value, or ACV. The problem is, for the first few years of a loan, you often owe more on the car than it's actually worth. This is called being upside down or underwater on your loan. Let's imagine you total your car. The insurance company determines its value is $22,000. They write you a check for $22,000, minus your deductible. But you look at your auto loan statement, and you still owe the bank $27,000. The insurance check pays off most of it, but there is a $5,000 gap. Without gap insurance, the bank is going to come to you for that $5,000. You will be forced to write a $5,000 check for a car that is now a heap of twisted metal. It's a financially devastating scenario. Gap insurance is designed specifically to pay off that difference, making you whole with the bank and allowing you to walk away clean. If you have a loan or lease, this coverage isn't just a good idea. It's essential armor. And so, we've come to the end of the page. We've journeyed from the basics of who you are and what cars you drive, through the bedrock of liability protection, past the crucial shields of uninsured motorist and medical payments, and finally we've armored your vehicle itself with collision, comprehensive, and the vital endorsements that plug the final gaps. This document, this declaration page, is no longer just a confusing piece of paper the insurance company sends you once a year. It is a blueprint. It's the detailed schematic of your financial fortress. Every number, every limit, every deductible is a brick in the wall that stands between your family and financial ruin. So now I'm giving you a mission. Don't just click away from this video. Pause it. Go find your auto insurance declaration page. Find it in your email in your filing cabinet, or log into your insurance company's app. Lay it out and look at it. But this time, you're not looking at it with confusion. You're looking at it with understanding. Look at your liability limits. That 25/50/25. Is that really enough to protect everything you've worked for in a world of $50,000 trucks and $100,000 medical bills? Look at your uninsured motorist coverage. Does it match your liability limits, creating a perfect shield? Or is there a dangerous gap? Look at your deductible. Can you truly afford to write that check tomorrow morning if you had to? Look at your endorsements. Are you one breakdown away from a massive towing bill? Are you one accident away from paying $1,000 for a rental car? If you have a loan, are you protected from that catastrophic gap? These are the questions that matter. And now you have the knowledge to answer them. Your final step is to take action. Call your agent. Go to your insurer's website. Get a quote to see how much it costs to raise your liability from $50,000 to $250,000. You will be absolutely shocked at how little it is. The difference between a weak policy and a strong one is often less than the cost of a few cups of coffee a month. Don't settle for the minimum. Don't settle for a policy you don't understand. Build the policy that lets you hand your keys to your spouse or your child with peace of mind. Build the policy that lets you sleep at night, knowing that if the worst happens on the road, it will be a tragedy, but it won't be a financial catastrophe. The single most important safety feature in your car is not the airbag. It's not the brakes. It's the piece of paper that ensures you can rebuild your life after the worst day. Don't just drive insured. Drive protected. Drive smart.